Welcome to the Deep Dive. We're jumping into the Q3 FY 2025 earnings for Dave & Buster's ticker PlayAY. And this one was a really interesting one. The call was on December 9th, and it was a very mixed print that led to a massive swing in the market.
It really was, and that's the core tension we need to unpack. Our mission here is to get past those headline numbers and into the operational substance.
Yeah.
Because revenue missed, yes, but the stock then surged over 12% the next day.
Right.
So we need to figure out what exactly management said, what details about their turnaround, convince the market that, hey, maybe Dave & Buster's is finally getting its act together. It's a pure execution story.
Okay, so let's start with that top line because, at first glance, things looked pretty grim. If you were just looking at the financial snapshot, the street was not happy.
Not at all. The overall print was challenging. Revenue came in at $448.2 million. That fell short of the $460 million the street was looking for. And it's a 1.1% decline year over year.
Which, for a growth company, any decline year over year is a red flag.
A huge red flag. And that weakness was really driven by the core traffic metric.
That brings us to comparable store sales. The expectation was already pretty soft, maybe down 3.2%, but they actually came in worse.
They did. Comp store sales were down a full 4% year over year. So if you were just looking at that data sheet, you would have every reason to be negative. Traffic is still a struggle.
But, and here's the massive plot twist, the thing that immediately complicates the whole story is that despite missing on sales, despite comp sliding, they somehow managed a profitability beat.
They navigated it strategically. I mean, the optics were bad, sure, but they reported an adjusted net loss of $1.14 per share.
Now, that's a wider loss than last year's Q3.
It is, but it was just enough to slightly beat the analyst consensus, which was for a $1.16 loss. So this tells you management was being incredibly aggressive on cost controls.
And the market loves to see that kind of discipline.
Exactly, but we do need to reconcile that with the obvious pressure points. They beat on EPS, fine, but we saw some pretty noticeable margin compression that doesn't usually happen together.
So how did that work?
Well, it's the classic tension between operational efficiency and high fixed costs, especially their debt. Adjusted EBITDA, earnings before interest, taxes, and all that, it declined to $59.4 million.
And that's what really hits the margin.
That's the key. It led to a 13.3% margin, which is down from 15.1% the year before. So yeah, they managed costs well enough to beat the loss estimate, but the overall margin structure is still getting worse because they just can't leverage their fixed costs when comps are down 4%.
And we saw a really telling mix shift in the details, right? It kind of confirms where the weakness is and where the strength is. Entertainment, their bread and butter, was struggling.
Yes, entertainment revenue. The games, that was the major drag. It was down 5.2% year over year. But the bright spot, and really the first sign of successful execution, was in the kitchen.
Food and beverage.
Food and beverage revenue actually climbed 6.6%. It's so clear that F&B is the first piece of this back-to-basics plan that's really starting to work.
Okay, so that F&B success is the perfect bridge into the operational turnaround. The CEO, Tarun Lal, he framed the quarter not by the headline miss, but by what he called substantive progress on this plan. He laid out 5 areas: marketing, F&B, operations, games, and remodels. Let's really get into these pillars because this is why that stock jumped.
And what's so fascinating is that the market didn't seem to care about the negative 4% comp for the quarter. It cared about the trajectory. The most encouraging data point was Pillar 1, comp stabilization. While the whole quarter was down 4%, management revealed that there was a clear sequential improvement in same-store sales each month of Q3.
And they actually put a number on that inflection point, didn't they?
They did. They said by the final month, by October, the comp decline had narrowed significantly to only about 1%. And they specifically said those better trends carried right into November.
And for you, the listener, this is why the stock exploded. For a business with such high fixed costs, rent, utilities, salaries, getting comps from -4 to -1, that means your marginal revenue is suddenly covering a way bigger chunk of those costs.
It just dramatically lowers the risk profile of the business, even if they aren't, profitable yet. They are slowing the bleed.
That makes perfect sense. They're getting closer to that break-even point. Okay, let's move to Pillar 2, the food and beverage reinvigoration, which was the first real concrete sign of success. How are they driving that growth?
It's all about smart strategic product bundling. They launched a new menu in October, brought back fan favorites, and it immediately improved F&B comms. And it led to higher average checks because the product mix was just better. They weren't just selling more cheap sodas, they were selling higher margin meals.
It sounds like they're just getting more out of every visit.
Exactly. The key innovation here is the focus on what they're calling smart value combo offers, the eat and play combo, for instance. Management was thrilled to report that this is resonating deeply. It's significantly improved guest attachment to a double-digit percentage. They're converting gamers into diners, and that's a structural fix.
It changes the whole revenue model. Let's look at pillar 3.
Right.
Marketing. They already have high brand awareness, so the challenge is just getting people through the doors.
And they're shifting away from, just scattershot messaging to a much clearer, more disciplined, and genuinely data-driven media mix. We're talking linear TV, connected TV, and digital, all aimed at converting that awareness into actual traffic.
But the real insight here, I think, is the creation of a whole revenue management team. Why is that specific change so important?
It just signals a maturation of the company. Instead of guessing what works, this dedicated team is now testing games, promotions, and creative messages well in advance. Think of it like A/B testing on a massive scale. It eliminates guesswork and protects those tight margins.
Okay, now here's where it gets really interesting for an entertainment brand. Pillar 4, games and innovation. The call focused heavily on high ROI content. What stood out to you?
The confidence they expressed in the 2026 pipeline was pretty notable. It's supposed to feature 10 new games tied to strong, culturally relevant IPs. But the real star of the show, the thing they can pull on right now, is the human crane attraction.
Yes.
Yeah.
The ultimate novelty game. Is management banking too much on one game here, or is the return really that good?
They are banking on the proven return. They were very clear about this. It's rolling out across all the remaining D&B locations, 70% done by year-end, and it's coming to main event in Q1. And the reason for the excitement is the stated outcome. It delivers an immediate and proven sales lift with less than a one-year ROI. It's a high-margin, low-risk way to boost the midway.
So the operational story is clearly gaining momentum. Sequential improvement, F&B success, data-driven marketing, a high ROI game pipeline. But we have to connect this back to the serious financial realities.
That is the critical connection. Let's look at their capital spending. They talked about a revamped remodel program 3 are already under construction. That's supposed to be way more efficient. They believe this new prototype will yield a 700 basis point uplift in productivity.
And just for our listeners, 700 basis points is 7 percentage points. So what does productivity even mean here?
It means higher sales per square foot. They believe by focusing on this refined design, they can get a 7% jump in performance while spending their capital more wisely.
And they're still growing the actual footprint.
They are. Q3 saw 1 new D&B and 3 new main event stores. But the really efficient growth, I think, comes from their international strategy. They opened their 3rd franchise in the Philippines with plans for at least 4 more in the next 6 months. And they have agreements for over 35 stores secured. That's highly efficient, low capital growth.
This all sounds great, but the elephant in the room is still that interest expense. They generated $58 million in operating cash flow. They have $440 million in liquidity, but that interest number is just jarring.
It's the ultimate pressure point. That net interest expense of $40.2 million is just weighing so heavily on the bottom line, especially when your EBITDA margin is compressed down at 13.3%.
So that's the reason they're booking losses.
That's it. The stores are profitable, but the debt service eats it all up.
Which raises the big strategic question. How long can the market tolerate that drag?
And management's guidance theme basically addressed this. They said, without giving formal numbers, that free cash flow and margin expansion are entirely contingent on getting to flat to positive comps. Until they hit that inflection point, the leverage is a huge pressure point.
So if the print was so mixed, huge debt, margin compression, a revenue miss, why did the stock surge 12%? The initial after-hours trading was pretty quiet, right?
It was. The stock actually drifted a bit lower to about $17.74. But overnight, investors and analysts really dug into the turnaround plan. They saw the sequential improvement, that shift from -4 to -1. They saw the high ROI games. They saw execution. So the stock surged to around $20.20.
That's a massive vote of confidence. But context is everything here.
Exactly. You have to remember this stock had been absolutely battered. It was down over 51% in the last 12 months. When a stock is that depressed, any tangible sign of execution can set up a really sharp bounce.
All right, before we wrap up, we have to transition to our segment that is explicitly for entertainment purposes and is not financial advice. We're just exploring some ideas based on the material.
An absolutely necessary disclaimer. So if I were the, cynical hedge fund analyst pitching this call to the investment committee, the trade idea would be framed around that exact tension we discussed. Aggressive operational optimism running right into a high-risk financial structure.
Okay, lay it out. What's the outrageous but plausible trade idea?
The setup is this. The stock just bounced 12% on the narrative, pushing it over $20. But that $40 million interest expense and that compressed margin mean they have to deliver flat to positive comps immediately. The rally is based on hope, not fundamentals.
So you're betting against the speed of the turnaround.
Precisely. The trade would be a short-term pairs trade. You short the common stock, anticipating it pulls back toward that, more reasonable $17 or $18 range as we wait for Q4 proof. But at the same time, to hedge against the whole sector rising, you buy call options on the consumer discretionary ETF, the XLY.
So you're betting on the sector, but against this one company.
Correct. XLY gives you exposure to the broader consumer, which protects you from a market-wide lift. This trade isolates Playwise' specific execution risk, that they might not hit their targets fast enough while still having a stake in the overall health of consumer spending. It's a bet against the euphoria.
That does perfectly encapsulate the gap between the narrative and the reality we found. So that wraps up our deep dive. The key takeaway here is this was a classic turnaround story, where sequential operational wins completely overshadow the immediate financial losses.
Yeah, the focus has shifted from just managing decline to actually proving the strategy works. Management is laser focused on high ROI things like the human crane and the new remodels. But, and this is the final provocative thought for you to consider, given that $40 million interest expense, how long can the market afford to wait for these initiatives to translate into visible debt reduction before that valuation gets challenged all over again? It's really a race against the clock.